Here's something strange. You walk into a bank, and everything about the building is designed to make you feel safe. Marble floors, quiet voices, a vault door thick enough to stop a truck. It feels like the safest place your money could possibly be. But here's the paradox. The moment you deposit that money, it stops being yours in the way you think it is. Legally, it becomes the bank's money. What you're holding instead is a promise, a number on a screen that says the bank owes you that amount whenever you ask for it. Most of the time, that promise is kept without a hitch. But understanding what actually happens between the moment you deposit your paycheck and the moment you spend it reveals one of the most quietly profitable systems ever built. Not illegal, not secret in the conspiracy sense, just rarely explained in plain language. By the end of this video, you'll understand exactly how banks turn your everyday money into their profit, why certain fees exist at all, why your savings account pays so little while your credit card charges so much, and what you can actually do about it. Let's start with the part almost nobody explains correctly. What a bank really does with your deposit the moment it lands in your account. Chapter 1. Your money isn't sitting in a vault. If you pictured your deposited cash sitting in a drawer somewhere with your name on it, that's not how modern banking works, and it hasn't for a very long time. When you deposit money, the bank doesn't store it. It lends most of it out. This is called fractional reserve banking, and it's the foundation of the entire commercial banking system. Banks are required to keep only a fraction of deposits available as reserves. The rest gets loaned to other customers as mortgages, car loans, business credit, and credit card balances. Here's why that matters to you directly. Every loan the bank issues using your deposit earns interest. A mortgage might carry an interest rate of 6 or 7%. A credit card balance might carry 20% or more. Meanwhile, the interest the bank pays you for the privilege of using your money is often a fraction of a percent, sometimes close to nothing at all. That gap between what banks earn on loans and what they pay depositors is called the net interest margin, and it's one of the primary ways banks generate profit. It's not hidden information. It's disclosed in annual reports, but it's rarely explained to the average customer in a way that makes the incentive clear. Think of it like this. You hand someone a shovel, they dig up value with it, and hand you back a coin for your trouble. The shovel never stopped being useful. It just stopped being yours to use. This isn't a scandal. It's how the entire system of modern lending and economic growth functions. Banks connecting savers with borrowers is genuinely valuable. But understanding that your free checking account is actually raw material for a lending business changes how you think about the rest of the relationship. Chapter 2. The business model behind free banking. If the bank is quietly profiting from your deposits, why does it also offer free checking, free debit cards, and no monthly fees at all for many customers? Because banking isn't one product. It's a bundle of dozens of small revenue streams, and the free parts are often subsidized by the parts that aren't free at all. Overdraft fees are a well-known example. When an account holder spends more than their balance, the bank can cover the transaction and charge a flat fee for doing so, historically often in the range of $30 to $35 per occurrence in the United States, regardless of whether the overdraft was for $2 or $200. Regulatory pressure in recent years has pushed many major banks to reduce or eliminate these fees, but they remain a meaningful revenue source across the industry. And research from consumer finance regulators has repeatedly shown that a small percentage of customers, often those living closest to paycheck, account for a disproportionate share of total overdraft revenue. Interchange fees are another layer most customers never see. Every time you swipe a debit or credit card, the merchant pays a small percentage of the transaction to the bank that issued your card. You don't see this fee because it's baked into the price of goods, but it's a steady, largely invisible revenue stream running in the background of nearly every purchase you make. Then there's the interest rate spread we just covered, plus account maintenance fees, wire transfer fees, foreign transaction fees, and minimum balance penalties. Individually, each fee looks small. Collectively, across millions of customers, they add up to a business model quietly built on habits, inattention, and the assumption that most people won't read the fine print. None of this requires malice. It requires only that the average person doesn't ask the right questions, which is exactly why explaining it matters. Chapter 3. Why your credit score matters more than you think. Here's a question worth sitting with. Why does a 3-digit number, one you never asked to have calculated, determine whether you pay 4% or 20% interest on the exact same loan? Your credit score exists to answer one question for a lender. How risky is it to lend this person money? It's built from factors like payment history, how much of your available credit you're using, the length of your credit history, and the mix of credit types you hold. But here's what often gets missed. Credit scoring isn't just a background system quietly measuring your reliability, it actively shapes financial behavior. People adjust their spending, their debt payoff order, and even which accounts they open specifically to optimize a number that exists to make lending more profitable and lower risk for the institution measuring it. This creates an uncomfortable irony. The people who most need affordable credit, those with thin or damaged credit histories, are the ones who get offered the highest interest rates. Meanwhile, those who already have strong finances get access to the cheapest borrowing. The system isn't designed maliciously, but its effect is that credit becomes more expensive exactly when you can least afford for it to be. Understanding this doesn't just satisfy curiosity, it changes strategy. Small, boring habits, paying on time, keeping utilization low, letting accounts age, aren't just good practice. They're the mechanism through which you shift yourself from the expensive side of the system to the cheap side. Chapter 4. The psychology banks are quietly counting on. Beyond the mechanics of interest and fees, there's a psychological layer to banking that's just as important and far less discussed. Behavioral economists have long studied a phenomenon called present bias, our tendency to overvalue immediate rewards and undervalue future consequences. Banks don't need to trick anyone to benefit from this. They simply need to design products like buy now, pay later options, overdraft protection, or minimum credit card payments in ways that align with how people naturally think in the moment rather than how they'd prefer to think in hindsight. Take minimum payments on credit cards. Paying only the minimum feels responsible in the moment. You're meeting your obligation, technically. But minimum payments are often structured so that even a moderate balance can take years, sometimes decades, to pay off if only the minimum is ever paid, with the majority of each payment going toward interest rather than the original balance. The system isn't lying to you. The math is disclosed. It's simply not emphasized, because emphasizing it would work against the product's profitability. This is the quiet genius and the quiet problem of modern retail banking. It doesn't need secrecy. It only needs your inattention. Complexity itself becomes a kind of shield, not because anyone is hiding something illegal, but because a fully informed customer is often a less profitable one. Chapter 5. What you can actually do with this information. None of this means banks are the enemy. Banking, at its core, is one of the most useful inventions in economic history. It turns idle savings into homes, businesses, and infrastructure. But knowing how the system profits changes how you can navigate it. A few things follow directly from everything we've covered. High-yield savings accounts, often offered by online banks with lower overhead, can pay meaningfully more interest than traditional accounts, sometimes 10 times more, for the exact same safety and insurance protections. The gap exists simply because fewer customers bother to move their money to capture it. Understanding overdraft mechanics means you can often opt out of overdraft coverage entirely, letting a transaction simply decline rather than incur a fee. Understanding interchange and rewards means comparing what a card earns you against what it could cost you in interest if a balance isn't paid in full. And understanding credit scoring means treating it less like a mysterious grade and more like a system with visible, learnable rules. The deeper truth is this: the financial system isn't rigged in the sense of being illegal or secret. It's simply asymmetric. One side has designed these products for decades with teams of specialists. The other side is just trying to get through a normal week. Closing that gap doesn't require becoming a finance expert. It requires understanding a handful of core mechanics, the ones we just walked through, and applying them consistently. That's really the difference between people who feel like the system works for them and people who feel like they're working for the system. It was never about intelligence. It was about information. If this kind of clear, practical breakdown of how money actually works is something you want more of, consider subscribing. There's a lot more of the financial system worth understanding.